So I'm looking at where the stock market is now, and I'm saying it looks like we're getting into unsustainable behavior. I think stocks could very easily come down 20% or so back into the 4,000 region on the S&P 500. And if this more aggressive trend were to break, I think it could very easily come back down to the longer term support here in the 3,000 to 3,500. And that would be about a 40% decline from where we are currently. People think this is impossible to happen, um, but we do see this type of behavior happening over and over again.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fantastic discussion lined up today that I'm super excited about. Gold has broken out of a 4-year consolidation period, and in a matter of months, it's up about $500. Silver has recently busted through some key resistance areas that have held it in check for years, and inflation continues to surge higher with nothing imminent to slow it down. To talk about all of this and more, we're fortunate to have with us Christopher Aaron, founder of iGold Advisor. iGold Advisor is an intelligent research and independent analysis firm focusing on precious metals, commodities, and currency markets. They specialize in using cycles, proprietary technical analysis, and market psychology to gauge both long-term secular trends and short-term opportunities for profit. Their primary focus lies in intense scrutiny of the gold and silver markets. Chris is also a former CIA drone analyst turned anti-war advocate. This is going to be a great discussion. Christopher, thank you so much for joining us today.
Gary, thank you so much for having me.
Yeah. All right, let's begin our discussion here. Christopher, are you in the soft landing, no landing camp, or the hard landing camp, and why?
I'm in the camp where we still need a little bit more data to answer that question definitively. And if I could explain to you why, it's because there are several cross currents happening right now, all at the same time in the markets. I think investors are often looking for one theme, the single theme that is driving the markets now, or let's say over the next decade. Like, it's inflation. We know inflation is bad. I have some strong opinions on where inflation is going. And that is a valid theme, right? And so currency debasement is a valid theme. That is happening. And there is also progress being made in the world on technology, on innovation, on artificial intelligence, on space exploration, et cetera, nanotechnology, that is lowering the cost of living for all human beings on planet Earth. That is deflationary. Our progress as a species, as a civilization, is deflationary. And so I think oftentimes investors are looking for the one current when in reality there's two or three currents. Sometimes one current is exerting itself more than the other, sometimes the other current. But we have to take that into consideration and then look at the broad trends.
That's very interesting, and I would agree with that 100%. All right, let's discuss how you identify opportunities in the metals and commodity sectors using your proprietary technical analysis and other tools. Like, what is your technical analysis background and process that you use to help your analysis and to make your forecasts?
Yeah, so let me just give a tiny bit of history as to why I've arrived at this point of technical analysis. Basically, technical analysis, we're talking about the study of the price of the asset, whatever asset it is, whether it's the price of gold, price of silver, the price of the stock that we're interested in. I place the foremost emphasis on the price and observing the trends in the price, because that's actually what we really care about as investors. Most investors, if you really boil them down and put them on the spot and you say, hey, what do you really care about? They want to know, is the price going to go higher or lower of a specific investment that they're making? What most investors do, however, to arrive at that attempt at forecasting future price is they say, I'm going to learn about X, Y, and Z fundamental, these valid things, yes, but these world events that are happening, these trends in mining supply, trends in consumer demand, trends in this and that, and I'm going to extrapolate because X, Y, and Z, therefore the price of the asset that we care about is going to rise or fall. I say, forget about all those fundamentals. Don't forget about them. They're happening. They're valid. But the problem is, as human beings, we have to take a step back and remember that there are actually infinite fundamentals. I'm not exaggerating about that number. It's infinity. The infinity sign is how many fundamentals there are, because the fundamentals are the thoughts, the beliefs, the decisions, whether to buy, sell, wait, not buy, not sell, of every person around the world who is thinking about, who would think about, who might think about a specific asset class. You multiply that all up. How many thoughts is each individual having throughout the day regarding a specific market times 8 billion people? There are infinite fundamentals impacting the market. So if we're going to say, hey, let's focus on 1 or 2 or 3 or 100 fundamentals, we are literally taking 100 fundamentals divided by infinity and saying that that ratio is sufficient to predict the price. In mathematics, any number divided by infinity is 0. It's defined as 0. So functionally, if you're taking a fundamental, and by the way, we're talking about even valid fundamentals, suppression in the markets, central bank buying, hedging supply, you're taking any of those fundamentals and dividing them in by infinity, you are arriving at 0 predictive capacity. 0. And I cut my teeth with this in 2007, 2008. When I was overseas, ironically enough, I was in Afghanistan. In my former career, I spent some time working for the CIA, and they sent me to Afghanistan in
Thank
2007.
you for your service, by the way.
Thank you for saying that. I appreciate that.
Yeah.
I was in Afghanistan during the crash of 2008, and I had begun investing in precious metals 2007, early 2008, as I saw the signs of the financial crisis brewing, the bubble in the housing market, the crazy lending and everything that was going on like that. But what I observed, this was the earlier stages of my career, what I observed was that all those analysts who were focusing on the fundamentals, even the correct ones, the problems in the housing market, let's say, problems in the banking sector, they were looking at 1 or 2 fundamentals, and they were saying, therefore, the price of gold is going to skyrocket. Therefore, the price of silver is going to skyrocket. Therefore, the dollar is going to go to 0. And they were completely wrong in the global financial crisis. Not only did gold and silver not rise during the global financial crisis, silver fell more than the stock market in percentage terms. And the mining companies that we are talking about here fell. I'm not exaggerating these numbers. They fell by 90 to 95%. All of them. The large cap, Wheaton Precious Metals, Newmont Mining, Pan American Silver, Eldorado Gold, the small caps, the juniors. The juniors fell by 99%. The large caps fell by 90% in 6 months. If you guys have only been in this sector for the last 4 or 5 years and you think you've experienced volatility, wait till you buy based on one of those fundamental analysts telling you gold's about to go higher, and then the thing drops by 95%. I learned, therefore, in my career, not to trust any 1, 2, or 3 fundamentals, even if those fundamentals are valid. To get back to that infinity equation, even if you're looking at a dozen valid fundamentals, it has 0 predictive capacity. What we need to do is focus on the price of the assets that we care about. Is the price of the thing trending higher? Is it trending lower? Is it in a consolidation? That's what we care about. That's the only way to analyze the markets and to maintain sanity and financial health.
I appreciate that. Yeah. So, and I'm looking forward to digging into that a little bit more with you during this time. So, something that seems to move the markets quite a bit is the Fed, where they're going to move interest rates to, their jawboning, and other ways that they can affect markets. The Fed has been holding to this idea that rate cuts in 2024 are happening. Time is likely running out for them to occur due to the election in November, but with inflation clearly holding steady to going higher over the last few months, how can the Fed possibly lower rates here without setting off some kind of inflationary boom? So, what are you expecting them to do with rates?
It's the most absurd thing. The market has been obsessed with every word coming out of the Federal Reserve here for the last 2 years. Every phrase, every comma that Jerome Powell inserts into the statement. Oh my goodness, he switched the comma to a semicolon. Oh, buy, sell, but it's crazy right now. But it's also the markets that we're participating in. So we can't ask for these ideal markets that are more sane. We have to deal with what we've been given here. It would be utter insanity for the Federal Reserve to be cutting rates right now. We have inflation that is still twice what the Fed's goal is. And furthermore, when you look at the trend of inflation, it's not coming down anymore. It's basically plateaued at about 3.94%. The Fed's goal is 2%, which in and of itself is absurd because the Fed's mandate is for stable prices. Prices rising by 2% compounded annually means the currency is losing half of its value every 27 years. That's not stable. So, but let's leave that on the side. Even if you accept that they're trying to get to 2%, they're nowhere near that right now. Unemployment is fine. Unemployment is at 50-year lows right now. The economy is humming along. There is no reason for the Fed to cut rates this year, next year, anytime soon. Yet the market has been obsessed with this idea that the Fed is, I mean, if we just look back 6 months ago, the market was pricing in 6 interest rate cuts in 2024. Now the market's got a little bit of sanity and saying 1 or 2. I still think the market is wrong. I think there are no cuts coming this year. And if anything, there's going to be more like a hike coming later this year into next year. If I can show you one chart here that I would like to pull up,
Sure.
Talking about the inflation figures, what we're looking at here is the CPI figures going back for the last 75 years. These are the actual inflation figures. And you can see after peaking here in the year 1980, there have been several downward trends of lower inflation. First, a very steep downward trend here in the early part of the 80s that was broken higher. And then really this longer trend from 1990 all the way through 2021. Let's call this a generational trend of lower and lower inflation. I mean, still inflation, don't get me wrong, still prices rising, but less inflation as time goes on.
Yeah.
Notice right here, this red circle that I've drawn in here. In technical analysis, we would call this a decisive, impulsive breakout. It's a break upward in the inflation rate after a generation of lower inflation. We've had the initial impulsive spike here, and it looks like to me, I mean, this is what I do. I analyze charts in this kind of way for price data. It looks to me like inflation is simply retesting. This is a common phenomenon that we will see in markets where a market will break a trend and then come back and retest it. Mm-hmm. It appears to me that the market is stabilizing here in this range of about 4% inflation. And I think the markets are going to be shocked that the next significant move is not lower again, but it's actually for inflation, let's call it in the next 12 months, to re-accelerate to the upside. And I would not be surprised at all to see this level around 8 or 9% start to be tested again when we look into 2025, 2026.
So that looks awfully similar to the 70s, where we had multiple waves happening there of inflation. And it looks like between the second and third wave, there was a stabilizing around 6% to 7%, around 1976 to 78 ish. That whole area, there was a retesting, a stabilization, and then a shooting higher.
Yes. That's exactly what I'm looking for, is a similar type of scenario. I think most analysts suffer from a nearsightedness in the markets where they only look back at the last 10 or 20 years and they say, hey, look, every time inflation has spiked here in the 2000s, I mean, basically anyone who graduated from college or university, after the 90s has only lived through lower and lower inflation the entire time. Most people do not go back and study history from, let's call it, 2 or 3 generations ago. So I think the market is, I think it's going to play out similar, not exactly how it did in the 70s, but the message of inflation not coming back down to 0 or 2% looks to be very strong here, by the visible data, you know. And then
Yeah.
yes, I think we round up again in something similar to what we saw in the late 60s and 70s.
Yeah. Well, not only are people not aware of what's coming, then they're not set up for what's coming, both in their personal lives with all the debt that they have, but also in their portfolios.
Exactly right. Because I mean, the rates that people have, we're seeing the impact on the housing market right now. I mean, this housing market is really stuck because you have existing homeowners that may be locked in at interest rates of 3, 4, 5%. They can't afford to sell their existing house and rebuy their neighbor's house at today's rates. So they're just not selling, and then new buyers can only afford about 2/3 of the house that they could have afforded just 2 years ago because those rates are higher. So the theme of higher rates for longer is something that it's going to take the market several years to start adjusting to. Right now, the market still believes that this is a one-off event. I think it's really short-sighted for the market to be thinking that.
So that's a really good segue. So I want to get your assessment on the broader markets, the Nasdaq, the S&P 500, et cetera. And some analysts and experts believe the current markets are in a position that's comparable to the 1999-2000 top of the dot-com period. Others are saying that it's more analogous with the 95-96 period when the dot-com was just getting going. With this inflation paradigm shift as the backdrop, is there a period that the current one reminds you of, or is this going to be a unique market period in your assessment?
Yeah, so the jury is still going to be out on that. However, not for too much longer. We're going to have a very good answer on that shortly. What I want to do first is show you what's setting up in the market over the intermediate term, and then let's talk about those big picture topics. So let me show you my working model for stock market here. So we're looking at the broad stock market over the course of the last 20 years. You can, if we zoom in here and we talk about the global financial crisis, it looks insignificant in the big picture, but when you zoom in and you remember, I mean, this was a 60% decline in a year and a half in the stock market. This is what we talked about. This is when, the miners fell more in percentage terms than the stock market. They recovered quicker than the general stock market. But we look at this and then we zoom it out. We have a lot of lines and colors on the charts. These are my working charts that I'm sharing with the audience here. Typically for public consumption, we will annotate things a little more thoroughly. But if you simply pay attention to the brightest trend that you can see here, this magenta double line, here we are looking at the trend out of the crash of 2009. So we always start trend analysis from major multi-decade lows. And if you start to notice let me change this color here so that people can see this more clearly. If you start to notice the boundary of the channel that the market was taking out of the 2009 lows, we're talking about a very orderly rising type of channel. If you notice higher highs, higher highs, higher lows, higher highs, right? But really moving this sort of wave type of fashion until we get into this period in here in 2018, 2019, 2020, and you start to see the market attempting to break upward. You see these attempts to break upward from the otherwise quite orderly channel between the magenta and the blue that the market was in. Um, these disorderly initial parabolic breakouts are a signature. It's almost like looking at a footprint. You know, if you're a hunter or a trapper and you're looking for animal footprints out in the woods, and you see something that you recognize, and you might not know exactly when that animal is going to come back. You might not know exactly, you know, when the moment is going to be, but you can recognize the footprints of certain types of behavior. These attempts at parabolic moves higher by the market are signatures of unsustainable price action. When we look at all markets throughout history, we're only here looking at the S&P 500. I could give this example for so many different markets throughout history. But so notice here how in late 2017, the market attempted to break upward and then had this quick pullback. It looks small today, but this was actually a 10% decline in about 2 weeks in the market. It tried it again. Then we had this mini crash. This was about a 20% crash here in 2.5 months in the stock market. And then we had the prelude to this one. This was the coronavirus crash. This was a 30% crash in 1 month, all following the attempt by the market to start engaging in this parabolic sort of behavior. So fast forward to the present, you know, the Fed came in, slashed interest rates to zero, printed a few $1 trillion, literally handed out fresh printed money to individuals by all these stimulus checks and whatnot. We zoom this out and we see the type of behavior that the market has had now since that, where, I mean, it's gone from these attempts to break out to, I mean, it's really going quite near vertically right now when we talk about the last 3 or 4 years. Not only that, but then we look at sort of the most recent attempts at a more orderly type of channel. We're even breaking higher from that. So, you know, the stock market is exhibiting signatures, telltale signs here of unsustainable behavior. That said, we can often see unsustainable behavior continue for longer than most people would expect. You know, the phrase is markets can stay irrational longer than one can stay solvent, right?
Yeah.
So I'm looking at where the stock market is now, and I'm saying it looks like we're getting into unsustainable behavior. I think stocks could very easily come down 20% or so back into the 4,000 region on the S&P 500. And if this more aggressive trend were to break, I think it could very easily come back down to the longer term support here in the 3,000 to 3,500. And you know, that would be about a 40% decline from where we are currently. People think this is impossible to happen. But we do see this type of behavior happening over and over again. The type of work that I like to do, however, just to come back to the form of technical analysis that I've gravitated toward, is to really take the market in chunks. I don't like to give predictions 5 years out, 10 years out. I don't see the reason for that. I don't see how that really helps a whole lot of people in the day-to-day world. I like to say, hey, if the current support fails, where are we coming lower? Where's the next logical support? Is that 15, 20% lower? All right, that's our next chance for stability in the market. If that fails, then we come back to the very long-term support. I like to take markets in chunks and sort of intermediate chunks. It just makes it more manageable for me. But yes, stock market is showing a lot of unsustainable characteristics recently.
Yeah, it's interesting. So recently you had shared a short video clip on your Twitter where central bankers they're being interviewed, and one of them says, quote unquote, "We print money and people believe it. It's a great business to be in." Christopher, at what point will the people stop believing in the printed money and turn to something that has real tangible value?
Yeah, that was an amazing little interview there. I think those were the guys over at Davos or at the World Economic Forum, basically saying the quiet part out loud,
Yeah.
as as we would say. Um, we print money and people believe it. Yeah, exactly right. Well, I can't tell you when that mass psychology is going to change. It is shifting slowly. I do think that the fact that gold is at an all-time high now, silver is starting to show like it might want to break out. We've got Bitcoin at an all-time high, these competing currencies. I'm not necessarily a buyer of Bitcoin at these levels. I'm not necessarily a buyer of Bitcoin ever. That's maybe another discussion. Uh, but it is a reflection of the market's belief, whether we're talking gold or Bitcoin, that central bank fiat currency is really not to be trusted. But the problem is, I don't see a whole lot of mainstream belief about that. We're in this community, right? We're in this investment community. You, I, the listeners here are in this community of people who have or are now developing awareness as to the problems with central banking and fiat currency. But if you were to simply go out and, let's say, go to a local bar, go to a coffee shop, go to your children's soccer games, talk to your neighbors and take a poll of how many people are aware even, that the central bank exists, let alone what fiat currency even means, let alone even how to buy gold if you wanted to, I would estimate it's between 1% to 2% of the population max.
So is
Max.
it going to take a massive crisis to shake these people to the core to get them to become aware of something that they're not aware of? I mean, back in the 70s, I would imagine that the psychology was similar at the beginning of the decade as to what you're talking about here is today. But by the end of the decade, people were lined up, at the coin shops trying to get their hands on whatever they can get their hands on.
Yeah, exactly right. It could be a crisis. It could simply be these waves of inflation higher that we saw in the 70s and that the chart showed, as we looked at, should be setting up again over this decade. I will tell you, there's a few interesting sentiment indicators, though, that we can look at that show me that even though I think gold, when we talk about gold now at all-time highs, as you mentioned, Gary, having moved up about $500 here in the last 2 months, it's not going to continue moving in a straight line higher like that. There are going to be multi-$100 corrections along the way for gold. But that said, when we talk about what are some of those sentiment indicators that would be suggestive of the final top or a multi-decade top, because multi-decade tops can form in precious metals. I think investors need to remember this. Look, in 1980, at the peak, when everyone was worried about inflation, if you bought gold in 79 or 80, you were underwater for 20, 25 years, right? So I'm not a perma bull on any one asset class. But when we come back to either the example from the 80s, or I could tell you the peak that I lived through, 2011, which was about a decade long peak. We just broke above the 2011 peak in 2020, but then it fell back below it. So it's really only sustained above the 2011 peak here just over the last couple of weeks. So we can almost call that 2011 peak like a 13-year peak. I can tell you that the psychology now is nowhere near what it was even in 2010 or 2011. 2010, 2011, I had a dozen individuals coming up to me from other aspects of my life, totally unrelated to the markets. I'm talking, friends, people at the gym, people at other hobbies that I have, who were coming up to me, who knew what I was involved with. and were asking me, hey, how do I buy gold? Maybe I should buy some silver. What do you think about now? Out of all those people, I've had one single person outside of the existing precious metals community, one, and that happens to be my aunt, who I love very much. And she bought 1 ounce of gold based on that decision. So I'm just saying, whether we're talking anecdotally, whether we're talking inflation statistics, or, a lot of the charts that we look at, gold could be due for a correction here. Pullback can happen at any time. You want to be careful about chasing markets that are moving too strong too quickly. But I think whenever any pullback happens here, it's setting up for another wave after that. As you said, that psychology is nowhere where it would be suggestive yet of a long-term top.
Yeah. So, all right. So this is great. We're moving into gold. It's finally, like you just said, broken out of this 4-year consolidation trend, but really a 13-year, from the previous high. You were just talking about sentiment. Gold's broken out to this 4-year high now. It's raced to, I think today, to about 2390, if I'm not mistaken. But yet, like you just said, it doesn't seem like anyone really cares. So you have this massive consolidation period that normally, I'm not a technical analyst, but normally when you break a long-term consolidation period and break through that resistance, finally, after it even back tests, normally you're off to a new high, something new. It's a new paradigm. It's a new trend that is now taking form. That should get people's attention, but yet people are not. It's almost like they're asleep.
Yeah.
So, what is it going to take for them to wake up and realize what's happening?
I'm going to tell you, this is a time where I have a very strong opinion about what it is going to take for people to start waking up. I'm not afraid to say that. I want to show you the data that I'm looking at. Okay, great. So this is the big one. This is the generational perspective. I have not seen anyone else talk about this perspective. We're looking at the Dow to gold ratio. This is the quintessential classic battle between the industrial capacity and the age-old store of wealth. Are we in times where we're going to be moving upward as far as technology and industry, or are we in times where it's more important to be saving in sound currency? We talked about in the very beginning, there's often multiple currents going on. Most people are thinking about the battle that gold is facing versus fiat currency, which, as I said, is a legitimate battle. Gold is fighting against fiat currency for supremacy as far as money goes. But that's not the only battle that gold faces. Gold is also facing the battle between savings and industry. That's another completely separate battle that we're looking at. So here with the Dow to gold ratio, we're looking at it since the inception of freely traded gold. And the important point to remember is the lower that this ratio goes, it means the better that gold is performing. For example, here in 1980, gold peaked right here at 1-to-1 versus the Dow. Gold was $850 per ounce. The Dow was 850 points for a brief moment in time. That's what that means. Gold is stronger. Here, this is the highest level ever recorded in the NASDAQ bubble, year 2000, in favor of the Dow, when it cost 46 ounces, 45 ounces of gold to buy one share in the Dow Jones Industrial Average. So we're simply looking at two assets as a ratio here. And what should be extremely clear to see is that we are in this converging, we've actually here been in a converging, this is called a pennant triangle. It's a converging pattern where the highs are coming down, the lows are coming up. It's converging. We had some wild swings a couple decades ago, smaller swings, coronavirus. And now look, Dow to gold ratio for the last 3 or 4 years is basically flat. A couple minor little swings in here, but as a net sum, actually for the last 7 or 8 years, the Dow to gold ratio is completely flat. So we were talking about why is it that the public is totally unaware of gold? It's because this ratio is flat over the last 8 years. And what this means from a practical standpoint is that investors, mainstream investors, have done just as well in their 401ks, in their index funds, their stock market index funds, the SPY, the total stock market fund. They've done just as well. And other countries have similar programs. Canada has their tax-free savings account. Australia has their superannuation funds. We all have these, and most people invest in these mainstream stock funds, and they have done just as well as the price of gold over the last 8 years. And the proof of that is right here in this chart. Now, the thing about a converging pattern is that these patterns do not converge forever. They actually break out before the apex of the pattern is reached. These patterns never reach their apex. They break out sometime before the apex, and we're only about 2 years away, 3 years away here from the very apex of this pattern in 2027. A converging pattern breaks strongly in one direction or the other. It does not just meander like this forever, where functionally speaking, gold and the Dow have been trading 1-to-1 for the last few years. So I know that it is going to take a break of this ratio lower. 13.8 is the figure that would need to break the lower support band in favor of gold. Right now, the ratio is trading at 16.2. That's what would be needed to see that mainstream investor, the 99% of investors around the world who just blindly plow money into their index funds, would then wake up and start moving into gold. I have to make one more point, though, about this. There is the possibility, because this chart has not broken out yet, there is the possibility, and investors need to stay aware of this scenario. This is why I said I'm not a perma bull on any one market. I align with the markets. Gold has been doing very well recently, and I'm still aligned with it. But if this ratio breaks out to the upside, it doesn't mean that gold is necessarily going to collapse as measured in US dollars. But what it does mean is that we are going to be entering a period, if this ratio breaks 19.35, where industry and technology are going to once again lead the way and outpace the need for savings in any format, whether US dollars, cryptocurrency, or precious metals. And the way to think about that would be to come back to what we talked about in the very beginning. An investor can be right about major themes in the world. There is very high inflation. Central banks are sort of going off the rails here and losing control of the narrative. Those can all be correct fundamentals. And also, we can be going to Mars as a civilization within the next decade or two. And also, we can be advancing on artificial intelligence or nanotechnology or exploring underneath the oceans, right? And lowering the cost of living for everyone by those deflationary productive capacities. So it's really important to remember that both of these trends can be happening at the same time. And that Dow to gold chart, which is going to break, it's going to break here in the next 2 years. That's going to give us the forecast for the next 1 to 2 decades after that breaks. And I will be aligning with the charts. I talked about how I got nearly wiped out in the crash of 2008 because I listened to those perma bull precious metals analysts, the fundamental analysts, who said gold could only go higher. And the mining companies fell by 95% in 6 months. And I said, I'm never listening to those storytellers again. Even the ones that mean well. I'm not saying they're all bad individuals. It's just, it's not sufficient to pick 1 or 2 themes and say that that's the sum of the markets.
So I really like how you just gave a worldview using that Dow to gold chart. And I really appreciate your aligning with the markets, the collective intelligence of, hundreds of millions of people or more participating in the markets. Um, so aligning with that over a theme that you think could be, uh, you know, occurring. So I really appreciate that perspective. But we're still human. We still have biases. We still have perspectives. We still operate on probabilities. So if you had to, um, put on your humanness for a moment and take off your analytics hat and take off waiting until within the 2-year period that chart's going to break. Nobody's going to hold you to this, but which way are you believing that chart's going to break? Do you think it's breaking to the upside or to the downside?
I think we have setting up here a final wave higher in the gold price, in the silver price, and in the mining sector for the precious metals over the next 12 to 24 months. We're seeing the breakout right now. We talked about how the psychology is not yet anywhere near where it needs to be to suggest a long-term top. I think we are in the midst of the beginning of what could be a final wave for this cycle. Might take the gold price to 2,500, might push into the 3,000s. It might surprise me. It could hit some of those 3,000 to 5,000 numbers that people are talking about. My best assessment when I look at the sum of what's happening around the world is that after that peak in gold, in this wave that we are now beginning right now, is that gold is going to come back into more of a stable trading range. Can we call it, trading between 2,000 and 2,500, which is a good environment for certain companies that are, let's say, exploring or developing new gold mines. But my best take on it at this point in time, once again, if the chart shows me something different, I will switch my opinion. I have no problem saying, look, I thought one thing and then the chart showed me something different. Why would I get married to a position if the data is going to show me something different? My best guess on it right now, based on my understanding of the advances that are happening around the world, is that the chart is going to break upward in favor of industry and technology.
Interesting.
And that gold remains an important reserve asset for the store of wealth.
Very interesting. All right, let's talk about that last point, the reserve asset. So the U.S. dollar currency reserves for foreign nations seems to be dropping very hard. And instead, nations seem to be turning to gold in mass. So coming out of the 70s, they used to hold something like 70% of their reserves in gold. And that steadily dropped to about 10 to 15% for decades. And now since 2014, it seems to be ticking back up again. Do you see central bank reserves? Do you see the central banks continuing to plow in light of what happened with Ukraine and the United States sanctioning the Russian treasuries, et cetera? Do you see central banks foregoing treasuries within their reserve allocations and instead continuing to beef up gold?
Yes, but I don't care about that at all. As we talked about, that is one set of fundamentals that is impacting the market. I'm not negating that's impacting the market. However, that's only one set of fundamentals. Central banks can be totally wrong as well. There's the famous, Great Britain was selling all of its gold in the 90s, the famous Brown bottom where Prime Minister Brown sold the last of Great Britain's gold, functionally speaking, in 1999 at exactly the low. So if one was using that analysis in 1999 to say, hey, central banks are selling, therefore we should get out of gold, it was diametrically wrong. So who's to say central bank buying is not the inverse signal now suggesting a top. All I'm saying is central banks are not omniscient. They don't know everything that's going on out there. There are one set of buyers, there are one set of sellers, but where the central banks meet everyone else, meet the buying out of China, the buying out of India, the mine production, the hedging, the speculation, the manipulation, all of the above, it meets in the price.
So yeah, and so I think you make a very, very valid point. I would point out that there is a difference in that today there's multiple central banks, many central banks buying gold, whereas that was just one foolish central bank making that choice. It wasn't it wasn't, you know, a majority or even a substantial minority. It was one, versus today there is many examples of central bank buying. But I do appreciate your point. I think it's very valid. I feel like I read on your Twitter, I could be mistaken, something about a gold revaluation, but there has been a lot of chatter, and I'm sure you've heard of it, about a gold revaluation. What does a revaluation in gold look like to you? And if it were to happen, how do you see it playing out?
You know, I don't believe that that's something that I posted on publicly. I have seen other people, talking about that, but frankly, I've seen people talk about that for the last 15 years, every single year. I don't think there's going to be any sort of official revaluation. There's no way to do that. The only way to do that is when gold is officially tied to a currency. That's what the U.S. government did in 1933 when it revalued from $20 to $35 per ounce overnight. That's effectively what the U.S. did in 1971 when Nixon allowed the U.S. dollar to float against gold as opposed to officially backing it. It allowed that revaluation to happen. The revaluation is happening. It's happening right now, but there's no way, there is no capacity for central banks or governments to officially revalue it at this point. I would get rid of that thought entirely. The market, we have a free market for gold. It's doing it for us.
Yeah, I agree. So some are saying that silver might just be the most undervalued asset on the planet. Silver's recently broken a primary multi-year downtrend. There have only been 4 downtrend signals in the previous 20 years. The average result is a plus 102% move, and the average period of time for those was 8 months. So it's pretty explosive. When silver breaks out and moves, its up leg is very explosive. That would put silver in this cycle at about $50 an ounce by December of this year. Can you speak into this? What do you expect?
Yeah, I mean, those averages that you gave are correct.
When you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift.